Right. Hi, good afternoon. Today is Thursday, October 20th. My name is Ashley Glover. I'm here with attorney Vincent Russo, and we are happy to welcome you to our Facebook Live event. Do I have an estate tax problem, and what should I do about it? So, thank you all for joining us. Before we start, I do have a few quick housekeeping notes. To help minimize background noise, your mics are muted. You'll want to use the Q&A box to submit questions. We do have some time reserved at the end to answer as many as we can. Also, I believe a couple questions came in during registration. We'll go ahead and tackle those as well. This presentation is a half hour. We are recording and we'll email you the link to the video and let us know how we did in the survey. If you need to message me about anything, please use the chat window to do so. All right, so let's meet our presenter, Vincent J. Russo. Vincent is the managing partner at Russo Law Group. He has his Master of Law in Taxation, is a certified elder law attorney, and member of the Council of Advanced Practitioners. He's a co-founder of the Academy of Special Needs Planners, founding member, fellow, and fifth president of the National Academy of Elder Law Attorneys, and co-founder of the Teresa Alessandro Russo Foundation for Children with Special Needs, which was established in the memory of his daughter. He's a nationally recognized speaker and author on elder law, special needs, and estate planning. Vincent, thank you for putting this together and for being here today. So I'm going to hand the reins over to you.
My pleasure, Ashley. Thank you so much. And this is really an important topic. I mean, if you have an estate and it's subject to estate tax, we want to help you either minimize or eliminate that tax. So what we're going to cover today is, when do I have an estate tax problem? That's question number one. What can I do about it? And what strategies are available to save estate taxes? And we'll also give you the latest update on the tax laws. So the first topic I'd like to address is how to approach estate tax planning. And there are some steps that you can take. First, determining the size of your estate. Very important. We have to know what your estate in total is worth. Then we need to understand the estate tax rates and the exemptions from tax. Based on that, if you have a taxable estate, then number three, consider what strategies are available to save estate taxes. And four, then implement a customized estate tax plan. So 4 steps, and we're going to go through each step today. So let's start with, what does my estate consist of? And the easy answer here is, in a general way, it consists of everything you own or have an interest in at the time of your death. So you own a home, other real estate properties, all that real estate is included in your home, in your estate. If you held that real estate in a limited liability company and you own the limited liability company, it's part of your estate. Your bank accounts, cash, annuities, brokerage accounts, savings bonds, life insurance policies, retirement accounts and pensions, your vehicles, collectibles, jewelry, art. All of these assets, we have to look at the value of those assets, and that determines the value of your total estate. Now, we also have to subtract debts. So if you have a mortgage on your house, then we take the net amount of value. So we take, if it's $1 million house with a $300,000 mortgage, then it's $700,000. With regard to life insurance, it's the payout under the life insurance that counts. So it's not the cash value of the policy. It's the death value, the payout. Now, once we know what the value of your estate is, we also need to understand what the tax rates are and the exemptions. So for federal purposes, the total estate tax rate, the top bracket, is 40%. And the exemption amount is $12,060,000. So once I have an estate federally over the $12,060,000, I'm now being taxed at the 40% rate. If you're in New York as a resident, there's also the New York estate tax, in addition to the federal tax. And that rate is 16%, and the exemption is $6,110,000. Now, it's important for New Yorkers to understand that we have this concept called the New York State estate tax cliff. This is tough. If your estate is over $6,415,500, New York State takes the entire exemption away. And that's really bad news. So the formula is whatever the New York exemption is, the cliff is 105% of that amount. Now you'll see in the bottom here, note adjusted for inflation. So we have an update here. The federal government just issued Revenue Procedure 2022-38. And they've informed us that that exemption of $12,060,000 is going to go up to $12,920,000 in January of next year, 2023. So good news, the exemption's going up over $800,000. And so less would be subject to estate tax if you have a taxable estate. Now, the steps to saving estate taxes. We talked about determining the size of your estate, understanding the exemption amount, but there are a couple other concepts we want to just mention here at the beginning. The concept of step up in basis. That concept is that if you own an asset, you buy it, and it increases in value, and you sell it during your lifetime, you have a capital gain, subject to capital gains tax. When you pass away, the basis, the purchase price, and I'm going to simplify it here, of that asset steps up to the fair market value on the date you pass away. So let's say I own a house that I bought for $300,000, that's now worth $1 million. If I sold it today, I'd have a $700,000 gain. If I pass that asset on to my family upon my demise, the basis will step up from 300 to $1 million. And then if it was sold for $1 million, there'd be no capital gains tax. So if you do not have a taxable estate, it's important that we don't lose the step up in basis. So we want to make sure that plan, whether you have a taxable estate or a non-taxable estate, takes into account the step up in basis concept. I mentioned New York State has estate taxes and a handful of other states around the country, and the cliff. We want to avoid falling off the cliff. No one wants to fall off a cliff. So we'll talk about that. Once we have a situation where there is a taxable estate, then we want to look at the strategies that are available. There are gifting programs that can reduce or eliminate the tax, and the use of trusts is so powerful. And so there are a number of different types of trusts that we can look at. And then lastly, asset allocation. This is really important, especially for married couples, where each of the spouses or partners have assets, and we want to make sure the plan works to maximize all the exemptions for both spouses / partners. Now, let's give you a kind of a guideline here. You're a New Yorker, and you have figured out the size of your estate. If your assets are in excess of $12,060,000, then you should definitely be implementing federal and New York State estate tax planning. If the assets are over $6,415,000, then you do not have to immediately do any planning for the federal on the federal side because the exemption is so much higher. But for New York, you would want to do New York estate tax planning. If you're in excess of $6,110,000, you're still going to want to consider New York estate tax planning. And here, you also may want to consider federal estate tax planning because that exemption can always be lowered. And we'll talk about what's projected in the future here under the existing laws. If your assets are in excess of 5 million, then you may want to consider New York estate tax planning because your assets can appreciate in the future and push you into a taxable situation. Estate tax planning, state by state, it's going to vary. So you have to look at the laws in the state that you're domiciled. Now, to give you an example of what this tax could be, at $6,110,000, we don't have a tax. At $6,415,500, no federal tax, but the New York tax is $563,184. If you have an estate of $12,060,000, good news right now, no tax, the federal level, but look at this New York tax, $1,396,400. And if you have an estate in the area of 24,120,000 in my example, the federal and New York state estate tax is $6,819,600. This is a problem. Anytime you exceed the federal exemption, you've got a tax problem here, and Uncle Sam is now going to be a family member. So we look at what tax planning opportunities there are for you. One is to lower the value of your estate through a gifting program to individuals or to trusts. And there are a number of ways of doing this where you still can benefit from the asset that you're gifting, but you've lowered the value for tax purposes. Some of my clients say, well, I don't want to lose any control. I don't want to make it overly complicated. I'll fund the estate tax through the purchase of life insurance. Here, it's important that you put the life insurance in an irrevocable life insurance trust because life insurance is income tax-free, not estate tax-free. So you want to avoid any taxation of that insurance, and then that insurance can be used indirectly to pay the estate tax. Many clients will do a combination of those two concepts. Lastly, I mentioned for married couples, the credit, shelter, and marital trust approach and asset allocation. This is where, at the federal level, the good news is that we have portability. So if one spouse passes and they don't use their exemption or part of it, then that exemption or part of it can be used by the surviving spouse. In New York, we don't have portability. So asset allocation, making sure each spouse has assets in their name, becomes very important. Now, when we get into a gifting program, the federal annual exclusion per person is $16,000. The good news here, under the Red Proc, it's going to go up another $1,000 come January to $17,000. So you can reduce your estate by making annual gifts, or you can use your exemption. That's that very large federal exemption of $12,060,000 without incurring a gift tax. Looking at this annual exclusion approach, each gift of $16,000 can save up to $7,200 in estate taxes based on the federal estate tax rate. Now, if we want to do gifting beyond the annual exclusions, then there are certain assets we want to focus in on. These would be assets that I would say, let's Give it some thought, see what strategies are available, and let's do something with them. Assets with little or no appreciation, so the basis is close to the fair market value. Assets that we think will appreciate significantly in the future. So if I have an asset today that's worth $1 million, but I believe in the near future it might be worth $5 million, I can get it out of my estate at $1 million now, rather than have it being taxed at $5 million later. So we want to avoid the appreciation in that scenario being taxed. And then we can look at assets that you have no intention of selling. So we're not worried about basis here, because capital gains tax only comes into play when you sell the asset. So these are concepts that we need to consider when we're trying to figure out, well, what's best for you in a customized plan. Now, let's go through a couple examples. This is a gifting plan to save New York State estate taxes. Let's say the value of your estate is $12,060,000, no federal tax, but that New York tax, $1,396,400. Now, New York State doesn't have a gift tax law, and the federal exemption beyond the annual exclusions is that big $12,060,000. So if we gifted $5,950,000, reducing the taxable estate to $6,110,000, we don't have a tax. And we just had a plan that saved $1,319,600. This can be done, it's legal. And future appreciation on the gift amount would be estate tax free too. The only rub here is that New York has a rule that to avoid that New York estate tax, that gift has to be made more than 3 years from date of death. So planning in advance is important. You can't do this in a deathbed situation. As I mentioned earlier, life insurance can be income and estate tax free. And the way you do it is by gifting the ownership of the life insurance policy to another party or to an irrevocable life insurance trust. The irrevocable life insurance trust is the more protective way of doing it. Here again, in this scenario, both federally and New York, there's a 3-year clawback rule. So transferring the policy, getting beyond 3 years, is a way of avoiding any estate taxation. Or have the trust purchase the policy directly, and then there's no 3-year rule. So for example, if I had a client with a life insurance policy of $5 million and they had a taxable estate, and this happened recently with a client that had 20 million, if we took the 5 million, put it in the ILIT, get beyond 3 years, and if we say the combined federal and state estate tax rate is 45%, we can save $2,250,000 in taxes. This is serious money. This can make a huge difference in terms of what you can leave for your family. Now, there are more powerful techniques. We call it leveraging gifts. And the way we leverage gifts is by discounting the value of the gift. So we want to make a gift of an asset and have the government value it at a lesser amount, being offset by the federal exemption. So that federal exemption, those dollars are very valuable to us. So the more discounting of gifts in a plan, the more gifts we'll be able to make utilizing that federal exemption. So this is the strategy here when I have clients with more significant wealth, that we're going to spend some serious time with the powerful options we have. So these gift tax strategies that save estate taxes beyond the annual gift exclusion amounts, we can discount gifts to trusts. And we're going to talk about grantor retained annuity trusts, GRATs, and qualified personal residence trusts. Cuperts. We can use discounting gifting through a limited liability company, an LLC. We can do gift tax planning in a married couple situation with a spousal lifetime access trust called a SLAT. If we want to plan for multiple generations, which we call generation skipping, we can have a dynasty trust. We have charitable intentions, we can make charitable gifts, and there are certain types of charitable trusts that can be used. So we call this area advanced estate tax strategies, and I call it the alphabet soup of estate tax planning. Grats, where you can retain an income interest for a number of years and have the gift discounted. Qualified personal resident trust, Cuperts, where you can live in a home, but for a period of time and discount the value of the gift of the home to a trust. Or the SLAT, where we can freeze the asset value while retaining access to income and principal, if necessary, for the other spouse. So a couple examples of the Cupert and Grat. With a Cupert, we can transfer $1 million residence, retain an interest in the residence for 10 years. And if that person is at age 65 and the residence appreciates at 4% a year, we can save basically $500,000, $474,902, plus the future appreciation of that home. All right. So there are factors that weigh in on how the discount is determined, and we're happy to talk to you one-on-one about how that can work. With a Grat, as I said, we can put in this example $1 million, retain an income interest at 5% for 10 years. And for someone age 65 with 5% appreciation, the savings will be in the area of $405,545. A significant amount of money that can be saved through these strategies, while allowing you to continue for a period of time to have the use of or the benefit of those assets. We really can super leverage what we're doing through LLCs and S Corps. If we have an LLC, we can convert the ownership into voting and non-voting shares. We can gift the non-voting shares to a trust. And because there's a lack of marketability and control and lack of control, that gift gets discounted anywhere from 15 to 40% of the value of the gift. That's a very large discount. So in an example here, if I had a $20 million estate and I did no planning and passed away, the combined tax would be $4,776,080. If I implemented a new plan and I utilized the LLC concept of non-voting units and the concept of a grantor retained annuity trust, and I implemented that plan with $5 million, the projected payout during the term where I retain the right to the income would be $1,625,000. That would be coming back. And I still would be with a projected estate tax savings of almost $1 million, $990,103.05 to be exact. Plus future appreciation of the LLC units after the initial term would be exempt from tax. So there are assumptions that are built into this example, and everybody's situation is different. We take the size of your estate, we look at what that tax might be. We then think about which assets you would like to plan with. What's the value of those assets? What type of transfer do we want to make? Do you need to retain control? You don't need to retain control. What are you comfortable with? So this is an example where we could save $1 million for the client. Lastly, charitable gift giving. This is awesome for people who want to give back to their communities for advocacy, social purposes, educational, religious. So outright gifts are always good. Utilizing your IRAs is a good concept. Since they're going to be subject to income tax, you can avoid that by making a gift of those IRAs. You can gift to charitable trust. There are two types: charitable remainder trust and a charitable lead trust. And so these trusts can be very powerful, where you, in a remainder trust, can retain an interest for the rest of your lifetime, with the charity receiving a gift at the end. And it's a way of avoiding estate taxes on those assets, giving you a charitable deduction today to offset your tax today on the income tax side. It's a powerful concept. As I mentioned, funding gifts with qualified retirement funds can be very helpful. And the benefit of lifetime gifting, where it can get both the income and estate tax savings. So anyone who's interested in charitable giving or the creation of a charitable foundation, we're more than happy to help. There are also non-tax reasons for estate planning. And we shouldn't lose sight of this. Passing assets on to family without problems is very, very near and dear to everyone's heart. And so structuring it in a way, utilizing trusts is a protective way of doing it. Avoiding probate can be very helpful. Minimize court fees, legal fees. Also, with our COVID pandemic experience, when the court shut down, individuals who passed away with wills and had now the family submitting the will for probate had to wait months and months, or even over a year, before they could actually access those assets, because the courts were either shut down or slowed down in the processing of probate proceedings. It's really important to think about how you leave those assets, and we always talk about leaving them in the most protective way. Save trust to protect your family. We've created that type of trust where it can continue to be held in a protective way for a child or grandchild. Special needs trust to protect a loved one with special needs. And long-term care planning comes into play here, whether it's through long-term care insurance or Medicaid planning, and just really understanding what are the consequences if you need long-term care, which can be very expensive, and you have no plan in place. What can you expect? So what do I do now? Create a plan. Now is the time. Do not wait. Sometimes people call, when's a good time for me to think about estate planning or estate tax planning? And the answer is always the same. Now. Protect yourself now. No one knows what's going to happen tomorrow, a month from now, a year from now. So you want to not only create a plan, you want to make sure that if you have a plan in place, that you review it periodically to make sure that your legal documents are comprehensive and up to date. The key is to implement, whether it's to create a new plan or to update a plan. Implement. You can always change it in many different ways. Most planning is not irrevocable per se. And so doing it in advance, you have more choices, you have more options, you have more time to consider those options to make a really sound judgment on what you want to do. Time helps you plan in advance so that you can minimize estate taxes. So to sum up, there are various strategies that are available to save estate taxes. You really need to make a commitment of time, energy, and resources so that you can really put the right comprehensive plan in place. And then most importantly, you need to be comfortable with your estate tax plan. You don't want to do anything without really understanding it, that you're comfortable, that it fits with you, you can live with it, that you always protect yourself first, and you feel comfortable that that strategy that you're going to implement is going to make you happy, that you've saved significant estate taxes for your family. So with that, I'll pass it back to Ashley for questions.
Well, thank you, Vincent. If we do run out of time, please email me your questions. I've provided my email address in the chat window for everyone. We did have two questions that came in prior or during registration. We'll tackle those first, and then Vincent, there's a couple in the Q&A box as well.
Okay.
We had a question about how do you plan when you're married and the spouses aren't sharing information.
Okay, so I a couple thoughts here. One is that when you have a married situation, as I mentioned earlier, it's really important to think about how you hold those assets, because New York State does not have portability if you're a New Yorker. And so you want to make sure you're maximizing the exemptions. Also, each individual spouse or partner, has a right to plan in any way they want with their assets. Obviously, sharing information can be very helpful to have a holistic, comprehensive plan. So if someone is not sharing information with the other, or there's a reluctance to do so, it may be that you should just move ahead and implement planning on your own. Or it may be that each of you should have your own separate attorney to implement planning. Often when a married couple comes in, we have what's called a joint representation agreement, so that there is a consent to share information so we can do the best job we can. And if one party was not comfortable doing that, then we would suggest that they would need their own counsel.
Okay. The second question was sold condo, established trust. How will I be taxed? Should I place remaining bank accounts into the trust or leave them available for use?
Okay, so excellent question about funding a trust. If it's a revocable living trust and the primary objective is to avoid probate, then you should make sure all your assets that can be transferred into the trust are. And that would include bank accounts and real property and brokerage accounts. In that situation, you cannot transfer ownership of your retirement accounts into that trust, but you can change the beneficiary designation. If we're looking to further save estate taxes and we're a single individual, then we're dealing with irrevocable trusts, and we really would need more information as to whether it's a good idea to fund that irrevocable trust and to fund it with which assets. All right, we got a few more questions here. Does the trust need to complete a 1041 tax return even though only income or capital gains the trust has made was interest on cash in a trust bank account, which was $450? The condo will have no capital gains tax after the sale. It is my understanding that a 1041 only needs to be done for a trust that has income over $600. So it's here again, it's going to depend on the type of trust, and it's going to depend on the provisions in the trust itself. So if it's a revocable living trust, then all the income is reported by the person who set up the trust. And actually you can avoid a 1041, which is a trust income tax return, by using the individual Social Security number. If it's an irrevocable trust, then it depends on the terms of the trust. It can be written one way, that all the income is reported by the person who set it up. It can be written another way, in which the trust has to pay the tax. And it can be written another way, in which the trust and or the beneficiaries have to pay the tax. So if you have under $600 as a general rule, you are, well, I would stay away from this. I'm gonna suggest that the individual who asked this question email me, or so we can have a further discussion before I start answering in a general way. Okay, so we can talk more about that, I think, separately, because there's a lot of variations. All right, the next question: how does this apply to people who have 1 to 2 million, which includes home life insurance and savings? The good news is that if you have $1 million or $2 million estate, there are no federal estate taxes. Even if the exemption is reduced, there's a sunset provision for it to come back down to about $7 million in 2026. I think you're at $1 million, $2 million. You don't have a concern about estate taxes. So you wouldn't need to do estate tax planning. You need to do estate planning. The use of revocable living trusts, avoiding probate can be helpful, making sure you've protected your family in the way that you leave your assets. So that's where I would focus. The bad news is that at this point you don't have a taxable estate, and I wish you luck and hope you can parlay that 1 or 2 million into 12 million or more. Then you could do estate tax planning at a later time. All right, last here: does an estate tax filing need to be done if the estate value is below the limits? It's as a general answer, no, but I'm going to qualify it because of the federal portability law, that if you're married, then you need to file an estate tax return on the first to pass if you want to pass on the unused exemption to the surviving spouse or partner. So that's the answer to that one. I think, Ashley, is there one other one?
No, sir, we covered them. There was a thank you.
Okay.
For answering the question.
I appreciate the thank you. All right, Ashley, what makes us different?
All right. Our clients tell us that it's our dedication, accessibility, scope of legal services, and years of experience that gives them the peace of mind and confidence when working with us. We will not learn at your expense. This firm literally wrote the book on estate and elder law planning. We've helped over 17,000 families. We build relationships with our clients. We care about you, and we want to be your attorneys for life. On the next slide, we've provided a list of our services and all the ways that we can help you and your family. I would, of course, urge anyone who has further questions to give us a call right now. We are happy to speak with you. You may also, as mentioned earlier, email me any questions that you have.
Ashley, just a closing comment here.
Sure.
Just to mention that we have a very robust website, vjrussolaw.com, where you're seeing the different services. Terrific information, forms, checklists, resources. Take advantage of it. Also, our firm has 11 attorneys, and we stand ready, willing, and able to step right in and help you. So if you would like a consultation, start that estate planning that we've talked about, we're happy to meet with you.
Excellent. Finally, we appreciate all of you for joining us. Please leave us your feedback in the webinar survey. I know Vincent and I look forward to reading all of your responses right after this, and that survey will appear on your screen as soon as we close out the webinar. So Vincent, thank you for your presentation. Any other parting words for us?
Just to have a great day.
All right.
Be well and be safe.
All right. We look forward to hearing from you all. And until next time, be well. All right. Thank you.